The world is days away from an energy catastrophe that could send oil prices to $100 a barrel, and the United States is running out of moves to stop it. The Strait of Hormuz is on fire. Gulf oil giants are shutting down their biggest refineries. Iran is controlling who gets through and who doesn't. And the US, it's spending billions it doesn't have on a war it can't afford to lose. But here is what nobody is talking about. While Washington is burning through cash at an alarming rate, China is quietly buying gold, dumping US Treasury bonds, and getting cheap Iranian oil delivered straight to its shores. And when Basant went to Beijing asking China to ditch Iranian oil and buy American instead, China didn't even blink. The numbers are staggering. A $5 to $20 billion war bill. 4 million barrels per day, potentially going offline. Crude already up 30% and still climbing. And a bond market shock that could hit as early as March or April. The US is trapped. The Fed can't print. Borrowing costs are spiking. And China is sitting on a rare earth card that could cripple America's entire weapon supply chain overnight. So the real question isn't whether Iran is winning or losing. The real question is, can the United States actually afford this war? And the answer might shock you. The Strait of Hormuz has become the most dangerous choke point on the planet right now. Roughly 20% of the world's oil supply passes through this narrow stretch of water every single day. And today, that flow is under serious threat. Iran has used its geographical position to turn the strait into a weapon, selectively allowing certain vessels through, while blocking others. The consequences are already playing out in real time. Qatar has paused operations at Ras Laffan, the world's largest LNG facility. Saudi Arabia's Ras Tanura refinery, the single biggest oil processing plant on Earth, has effectively ground to a halt. Bahrain's refinery is literally on fire after a missile strike. And the port of Fujairah, one of the most critical shipping hubs in the entire region, is now under active attack. These are not small facilities. These are the backbone of global energy supply. When they stop, the ripple effects move through every economy on Earth within days. Food prices go up. Transportation costs go up. Manufacturing costs go up. Everything tied to energy, which is everything, becomes more expensive. The Middle East is no longer just a geopolitical flashpoint. It is the trigger for a global economic crisis that is already beginning to detonate. Oil markets are reacting exactly the way you would expect when supply gets threatened at this scale. Crude prices have already surged by more than 30%, and the momentum is not slowing down. Analysts and traders are now seriously pricing in the possibility of crude hitting $100 per barrel and staying there for an extended period. This is not speculation anymore. This is math. By mid-March, the total production cuts across the Middle East could reach 4 million barrels per day. Iraq alone has already cut refinery operations by 600,000 barrels per day, and a full shutdown there would pull an additional 2 million barrels off the global market. When you remove that much supply that quickly, prices do not just nudge upward, they spike hard. And a 30% rise in crude oil is not an isolated financial event. It is an inflation trigger that runs through the entire economy. Gas prices rise, shipping costs rise, the price of producing and transporting food rises, utility bills climb. Businesses that operate on thin margins start cutting costs, which means cutting people. The $100 barrel is not just a number on a trading screen, it is a number that changes what ordinary people pay for everything in their daily lives. Washington continues to tell the public that the war is going well. Trump has claimed Iran's navy is destroyed, their air force is wiped out, their missile capacity is gutted, and their leadership has been decimated down to a third tier of command. The messaging is consistent, aggressive, and confident. The problem is that the facts on the ground keep contradicting it. Iranian drone and missile strikes are still hitting U.S. defense systems in the Gulf. The Saudis, far from celebrating an American victory, are desperately activating back channels to negotiate directly with Iran and begging for de-escalation. Iran is still controlling the Strait of Hormuz and deciding on its own terms which ships get through. If the U.S. had truly destroyed Iran's military capacity, none of this would be happening. The war would be over, but it is not over. It is escalating. The gap between what the Trump administration is saying publicly and what is actually happening militarily is becoming impossible to ignore. And the longer that gap exists, the more it erodes the credibility of U.S. leadership in the eyes of global markets allies and adversaries alike. Here is one of the most damaging developments that is getting almost no attention. Iran is not just surviving this war economically. It is being actively funded through it. Chinese tankers are being waved through the Strait of Hormuz without interference. Beijing is loading up on cheap Iranian crude, shipping it home, refining it, and pumping it straight into the engine of the Chinese manufacturing economy. This arrangement gives Iran a reliable revenue stream that keeps the war machine running, regardless of how many sanctions Washington layers on. And it gives China discounted energy at exactly the moment when global oil prices are spiking. China is essentially getting a wartime energy discount, while the rest of the world pays a wartime premium. Every barrel of Iranian oil that flows to Beijing is a barrel of revenue that keeps Tehran fighting, and a barrel of leverage that Beijing holds over Washington. The U.S. cannot strangle Iran financially while China keeps the money flowing. And China has every financial incentive in the world to keep doing exactly that. This is where the situation reaches a level of strategic absurdity that is genuinely hard to overstate. Treasury Secretary Bessent has reportedly been pushing Beijing to stop buying Iranian and Russian oil and switch to purchasing American energy exports instead. Let that sink in for a moment. The United States started a war that is driving up global oil prices. That same war is making Iranian oil dramatically cheaper for China relative to the global market. Washington is now asking China to voluntarily give up discounted oil pay more for American exports, and in doing so, fund the very war that is benefiting Beijing's energy position. There is no diplomatic framing in the world that makes this request look like anything other than desperation. China has no incentive to comply. It has every incentive to keep the current arrangement exactly as it is. Asking Beijing to hurt its own industrial base to bail out American war financing is not a foreign policy strategy. It is a confession that the U.S. has run out of real options and is hoping its adversary will hand it a lifeline out of goodwill that simply does not exist. The financial cost of this conflict is becoming genuinely alarming. Early estimates put the total bill at around $5 billion as of early March. But given the pace of operations, the real figure today is likely closer to $10 or even $20 billion. The U.S. spent over $600 million just repositioning military assets in the region. F-15 jets that were shot down cost $350 million each. And this is before accounting for the cost of replacing depleted munitions, which the Department of Defense is expected to request up to $50 billion for. On top of that, the U.S. has fired hundreds of Tomahawk cruise missiles in this conflict, each one costing roughly $2 million. Those stockpiles take years and billions of dollars to rebuild. The fundamental problem is that the U.S. is fighting an asymmetric cost war and losing it badly. Iran is using $10,000 drones to force the U.S. to fire $2 million missiles in response. That ratio is economically catastrophic at scale. The Fed cannot print its way out of this without cratering the dollar. Bessent can issue bonds, but yields are already climbing and will continue to climb as markets price in both the inflation risk and the borrowing surge. The Treasury and the Fed are caught in a squeeze with no clean exit. The only people genuinely winning from this financially are Lockheed Martin, Raytheon, and the rest of the defense industry. China has not yet played its most powerful card in this confrontation, and the fact that it has not should be more frightening than reassuring. The United States imports approximately 80% of its rare earth minerals from China, with dependency exceeding 95% for several materials that are critical to defense manufacturing. A single F-15 fighter jet requires over 400 kilos of rare earths to build. A U.S. Navy destroyer needs more than $5,000 LB. A Virginia-class submarine requires close to $10,000 LB. Every missile, every bomb, every advanced weapon system the U.S. is firing at Iran contains rare earth components that can only be sourced at scale from China. China already took a warning shot in 2023, restricting exports of gallium and germanium, two materials essential to semiconductors and military electronics. That was a test run. A full rare earth cutoff would be something else entirely. If Beijing decides to halt rare earth exports, U.S. military stockpiles would begin drying up within weeks. Production of new munitions and aircraft would slow dramatically. The cost of every weapon system would skyrocket as manufacturers scramble to find alternative sources. A missile that costs $4 million today could cost $8 million or more in a matter of months. China has the ability to not just slow this war, but to economically price the U.S. out of it entirely. The question is simply whether Beijing chooses to pull that trigger. The de-dollarization signal coming out of China right now may be the most important long-term story buried underneath all of this. Even as the war escalates and the dollar sees brief rebounds, China is still steadily selling off its U.S. Treasury holdings, now approaching $680 billion and falling. Last November, China issued $4 billion in its own dollar-denominated bonds at the same coupon rate as U.S. Treasuries, and investors oversubscribed by nearly 30 times. The message from global investors is clear. They want diversification away from American financial instruments. They are willing to lend to China at U.S. Treasury rates, which means they view the risk as comparable or the opportunity as more attractive. Meanwhile, Beijing continues buying gold, adding 30,000 troy ounces just last month, bringing their total to 74.2 million troy ounces. Gold is trading above $2,500 and climbing. Russia, India, and several Gulf states are now settling more and more trade in currencies other than the dollar. The war is speeding that process up. Every dollar China puts into gold is a dollar it is not lending to Washington. Every country watching this conflict is drawing the same conclusion about the risks of keeping reserves concentrated in U.S. assets. The war is not just an energy crisis or a military crisis. It is accelerating the fracturing of the dollar-dominated global financial order, and that process, once it gains enough momentum, does not reverse easily. The bottom line is simple. The U.S. entered this war believing it could win quickly, cheaply, and decisively. None of those three things have happened. Oil is surging. War costs are spiraling. China is not cooperating, and the financial pressure on Washington is building faster than anyone in the administration wants to admit publicly. The Gulf states want out. Global investors are quietly moving away from dollar assets. And Iran is still standing. At some point, reality has to meet the narrative. The longer that meeting is delayed, the more painful it is going to be, not just for the U.S. government, but for ordinary people around the world paying higher prices for everything, while the bill for this war keeps growing. The question was never whether the U.S. could destroy Iran militarily. The question was always whether it could afford the consequences of trying.